heightened volatility in the short term and still sees energy and certain technology stocks as solid investment bets. Diana Avigdor is Vice President, Portfolio Manager, and the Head of Trading at Barometer Capital Management. She's at the TSX Broadcast Center. Hi, Diana. Great to see you as always.
Thank you very much. Nice to see you.
So,
maybe we can own some Splunk.
Splunk, yeah. And I'll dig into what they do. Actually, one of our guests, Mike Newton, he owns it. He likes to talk about it. Volatility, why do you see it coming?
You know, the VIX is at 11.5. Another point, and we're going to be an all-time low. The correlations are very low. Month end, look what's been going on in the bond market. It's worrying a lot of people. It could be that it's because growth is nice and steady. We don't want too much growth. We don't want too little growth. This does not give rise to inflation. There's going to be some asset allocation changes. They always are at month end. Market has been kind of sleepwalking, as Barron's was calling it on the weekend. It's kind of sleepwalking into a new high. Volumes are kind of light. So I expect a little more volatility around month end or a few days after.
So would you say for clients and for investors in general, hold on to your core positions, but maybe trim some of your more speculative plays?
Yeah, I think that given the way the market has been, and it has been pretty good, I'm hoping that investors have their core positions, which have been good companies with good fundamentals, with good yield. We've been talking to everybody at Barometer about yield, that yield has not gone out of vogue. So the core positions would be those with good yield and good yield growth. Given the risk-on environment of the last the last half of last year and some of this year, I'm hoping that people have gone a little bit into a little bit of risk. I would not add to those at the moment. I would keep a little bit of powder dry. If there is some weakness in the market, and we've had a really good stretch, I would definitely utilize weakness to purchase positions and even some risk on. Technology is looking really well. Biotechs have sort of stopped right at the support level, which was as expected. But as you know, the range on that and the volatility around that is very big. So it's a tradable product. So for traders, and I stress that it's for short-term traders, I would trade this market a little bit and be careful into month end and a little bit after. But for long-term investors, there's a lot of transformational issues going on here, which are positive.
Diana, we'll get back to you in just a second. And Michael has those Lionsgate numbers. How do they look?
Depends on what side you're looking at. It's a miss on the top line, looks like a miss on the bottom line as well. I'm looking at Q4 revenue coming in at $721.9 million, which was actually below what they pulled in this time last year. For their full year revenue, also misses street expectations of $2.7 billion at 2.6. On the bottom line, once you X out certain items, we're looking at a miss by a penny at 42 cents per share. Bloomberg is reporting the estimate was 43. Mark, my estimate from Thomson One is for 40 cents. So we're looking for an apples to apples comparison here, and I think we're finding it in the form of a miss by a penny on a per share basis. Company says its filmed entertainment backlog clocks in at $1.2 billion, and they're boasting in the press release here of record margins, and I'm down to page 9, and I still don't see what those record margins. Overall, motion picture segment revenue for the full year, $2.1 billion. That was $200 million less than what they had this time last year. The fewer releases get the blame for that. Home entertainment revenue coming in at $863.9 million for the year, which was about $100 million less than this time last year. Again, fewer titles and a growth in managed brands. Television revenue, which is, of course, your Mad Men and Orange is the New Black, looking at a weakness of about $50 million year over year as well. So less product going out the door at Lionsgate, Mark, playing a role in the company missing street expectations.
All right, Michael, we'll get back to Diana Avigdor over at Barometer, the TSX Broadcast Center. Diana, you have a lot of ideas here for our viewers. Let's get to a few of them. You're looking at, in the energy sector, heavy oil, production growers, and sustainable dividend yield. Maybe you can pick one from each sector. Which is your favorite heavy oil play?
I would maybe highlight CNQ. It's looking technically great. It has been going the right path. We like the sector. In terms of dividend growers, maybe I would highlight Whitecap. We're looking at the dividend growers and dividend payers and dividend sustainability at 5%. It's great. In terms of production increases, and service companies. Those are sectors. So in the energy sector, this is exactly what I meant when I said transformational. Yes, we have a lot of oil, and yes, things are changing both in terms of the technology, but it's a really robust sector, and a lot of positive technical and technological changes are going on. And sustainability of dividend in a mid-cap energy company in a time like this is pretty good. You don't have to just buy financials or utilities for that dividend, and dividend is important at this point.
Now, as far as production growers, there are a number of them out there, as you know, in Canada that are doing quite well. But you like, among them, Concho Resources. Tell us about this one.
Concho Resources, and also there has been some, FANG is another one in the U.S. in the Permian Basin and the Eagle Ford area. This is where we've seen most of the production growth, and these companies have exposure to that area.
Thanks for your time today, Diana. We'll see you soon.
Thank you very much.
Diana Avigdor, Vice President, Portfolio Manager, and the Head of Trading at Barometer Capital Management.